let's go ahead now and turn this over to Tanya and Sean and get started.
Awesome. Thank you, Amy, and thank you everyone for joining us today. My name is Tanya Rule, and I lead the Affordable Care Act services for the firm. I have been with Eide Bailey. This is my 20th year, and I've been doing the ACA since 2010. So I sit in our Mankato, Minnesota office. Obviously, currently I sit in my daughter's bedroom. That being said, if you call me, my number's below and that rings right to my home office, and then I can get my email as well. So I'll have Sean introduce himself and then we'll go ahead and get started.
Yeah, thanks, Tanya. My name's Sean Delury, and I've been with the firm for about 9 years. I have 15 years of healthcare and ACA consulting experience. Like Tanya said, I have also been involved with the ACA since it was passed in 2010. So it's already been 10 years. So same information below on email and phone number. And I am also working, I'm out of the Minneapolis office, so we're still working out of our homes. So that's a bit about me. And with that, I'll turn it back over to you, Tanya.
Awesome. Thank you, Sean. So here are our learning objectives. Now, for those of you who join us every year for this, you'll see that most of our learning objectives are the same. We do have a few new things we're going to talk about, but this time of year, we like to go back and kind of rehash all those old rules, make sure that you have a good basis before you go into the filing season. We're going to want to make sure that we do our forms correct this year. We'll talk about that a little bit later. It has to do with a good faith effort and whether or not we feel we'll have that this year. So here are some ACA terms. Hopefully they are just, again, a review for all of you. Obviously, the affordable coverage, that changes every year. Sean will go through that when we get to that point. Now, as many of you know, that federal individual mandate is no longer out there. That started in 2019. The misconception, though, is that we've had employers think that there's no employer mandate because there's no individual mandate. And that, unfortunately, is incorrect. So if you're one of those employers that missed your filing this last year, my recommendation would be go ahead and get those forms filed as soon as possible. Now, I did have some employers ask me, hey, since there's no individual mandate, will we still have to report for self-funded plans, the individuals that are on the plans as well as anybody on their plan? Remember, that was part 3 of the 1095-C or the 1095-B if you're a small employer. And it listed out which employee took insurance, which recipient took insurance, and who was all on their plan and the months that was on the plan. So the IRS came out with the draft forms of the 1095-C and the 1095-B about 3 weeks ago, and that information is still required. So they're going to use that information for those individuals that get the premium tax credit. So you're going to want to make sure you fill it out. Now, there's a couple different spots in this presentation that we will mention. The 1095-C has changed this year. So it's the first time that it has changed. You'll notice that part 3 of the 1095-C is now on a second page. So if you have a self-funded plan, make sure that you catch there is a second page to that 1095-C. It could mean potentially that employers might have lower amounts of penalties this year, and the reason is because, remember, in order for an employer to receive a penalty, and that's that pay or play penalty that Sean will go through in a little bit, we have to have an employee who is a full-time employee go to the exchange and say they didn't receive an offer of coverage, or the offer of coverage that they received was either inadequate or unaffordable. So because there's no individual mandate, maybe we'll have less employees that were offered of unaffordable insurance go to the exchange and receive a premium tax credit. If that's the case, then yes, indeed, we could have a lower 4980HB penalty. Now, new these last couple of years, we had some states come through with an individual mandate of their own. So what that means for employers is if you have employees in that state, or if you're located in that state, you're going to want to look at those rules. We're not going to go into it in too much detail here because looking at the registration list, I don't think we have a lot of folks in those states. What you're going to want to see is if you have a self-funded plan, a lot of those states that have mandates this year or last year are requiring that you file those forms with the state so they can track who had minimum essential coverage. So last year we had New Jersey and Washington, D.C. have the requirement. So again, if you have individuals in those states, New Jersey, even if they're a part-year resident, you're going to want to file those forms with the state. Now, new for 2020, we have 3 other states coming in, and that's California, Rhode Island, and Vermont, although you'll see Vermont has a 0 penalty. So if you, for example, are living in that state, you have to have coverage just like you had to have prior to 2019 for the federal government. There are exceptions where you could get out of that penalty. But what you need to know as an employer is if you have an individual in California and you have a code section 6055 filing requirement, remember that's for those individuals that have, or those employers that have self-funded plans, you will have a filing requirement with California. Now, if the IRS extends their due date, so usually remember we get that extension the end of November or the beginning of December, if the IRS extends that and says, listen, we have an extra month to give those forms to our employees, look at these states and see if those states extended their deadline. So right now, California says that you have to give those employees a copy of their form by January 31st. So if the IRS extends it, excuse me, and you don't give those employees a form, you could miss that California deadline and be subject to some penalties. So now we're going to talk about 3 types of health reimbursement, and it should say arrangements, my apologies. There, of course, is another type of health reimbursement arrangement, and that is the type that is tied or integrated with your group plan. Nothing has changed there, so we're not going to go through that. So I want to work our way from the bottom on up on this slide. So that one employee HRA. So under the market reforms under the ACA, anyone with less than 2 employees, if you have a plan with less than 2 employees, the market reforms don't apply to you, so to speak. You are going to want to make sure that that's premium only HRA so that we don't have to worry about the non-discrimination rules. Now the QSERAs are next. Those are our qualified small employer health reimbursement arrangements. They've been out for a few years. Nothing new here. I do know there are some employers that hadn't heard of this, and the topic got brought up when we started talking about the ICRAs. Those are the individual coverage health reimbursement arrangements. So back to the QSERAs, if you offer a QSERA, you can't have a group plan. You could offer a QSERA, and if an employee takes that QSERA but it's deemed unaffordable, they're still able to go to the exchange and receive a premium tax credit. Of course, that premium tax credit would be reduced by the amount of the QSERA. So now on to the ICRAs. The ICRAs are new in 2020, and ICRAs, they can go to any size employer, where the QSERAs were only for those small employers. Now, honestly, we could spend the rest of the hour talking about these ICRAs. They're kind of a neat thing to have, honestly. If you can't find a group plan that suits you and your employees, or if you're a small employer and you didn't want to have a group plan, you just wanted to give your employees something, keep up with the Jones, so to speak, ICRAs might be a good thing for you. Another good thing about the ICRAs, if you will, is it's a way to buy down that employer penalty. So the player pay penalties. If you offer an ICRA, and let's say you offer that ICRA to 95% of your full-time employees, now you have avoided that 4980HA penalty regardless of that dollar amount of that ICRA. So if I had, let's say I had 100 employees and I offered a $1,000 ICRA to all 100 employees that are full-time, I'm not going to be subject to the larger of the 2 pay or play penalties. Remember, that's your 4980HA penalty, because like Sean will state in a minute, that penalty will apply to all of your full-time employees, less the first 30. Now, if the ICRA is deemed unaffordable, and that employee waives that coverage and goes to the exchange and receives a premium tax credit, that employer, assuming that that employee was a full-time employee and worked for an applicable large employer, that employer will have that 4980HB penalty. However, that 4980HB penalty, I believe it's $3,860 this year, is not the end of the world. Oftentimes when we have a typical group policy, employers are paying more than that amount for their portion of the employee's health insurance. Now, remember, penalties are non-deductible, so you have to take that into consideration. But the ICRA, unlike the QSERA, if someone takes the ICRA, they're not eligible for a premium tax credit. Also, unlike the QSERA, the ICRA, if we have a group plan, we can offer the group plan to one group of employees and an ICRA to another class of employees. We just can't offer both of them to the same class of employees. So here I've listed out just some of the ACA penalties just to kind of put them in one spot so we can all see what's going on here. So Sean, again, is going to talk about the pay or play penalties. We also have that section 6721 and 6722 penalties. So those are our failure to file correct information returns and payee statements. Now remember, most of us didn't have to worry about those for the prior years because we had that good faith effort reporting. So as long as we made a good faith effort, we should be able to get out of those penalties. Will we have that for 2020? Well, we won't know until, like I said, the IRS comes out with a notice if they allow it and if they extend the returns, which won't be until November or December. I'm 50-50 if we'll get it again this year. We'll see later about a report that came out and kind of said, you know, to the IRS, we think you should come down a little bit harder on these penalties. So I'm thinking we might not have that good faith effort for our 2020 forms. That means you're going to have to do a good job this year filing your form so you don't get that penalty. We also have the 4988 or 80D penalty, my apologies. So that penalty, let's say I offered that one person HRA, but let's say that I offered it to 5 different people and I didn't have an ICRA set up. That 4980D penalty would kick in, and that's $100 per day per person you're doing that to. So it's a $36,500 penalty per year per person I'm doing that to. So remember, 50 is still our magic number, right? If we have 49.99 employees, we can still offer a group plan, but we don't have a filing requirement on that 1095-C form. And remember, if we don't have a filing requirement, then we wouldn't have any of those ACA pay or play penalties. Now, that being said, remember our ACA status is always based on our prior year numbers. So to determine if I'm an ALE for 2020, I would actually have to look back at my 2019 calendar year. Remember, it's 120 hours per month. It's not 130 hours. That's if you are a large employer, which hours you look at for a full-time employee. Again, for ALE status, it's 120 hours. Now, I did have clients calling me this summer saying, hey, listen, we furloughed employees, we laid off employees. We're never going to have 50 by the end of 2020. Am I a large employer for 2020? And the answer is yes. Remember, your ALE status is determined on the prior year. So if you reduced your staffing due to COVID-19 or due to whatever reason, that would mean that in 2021 you would not be a large employer if, for example, you were at 49.99 at the end of 2020. Remember also, if you're an employer who is a small employer and you acquire another business and therefore on that date of acquisition, you become a large employer, you are a large employer for 2020 on that date of acquisition. Another thing I get a common question on is employers will say, listen, I'm starting a new business. I anticipate having 60 full-time employees. Do I get to wait a year? And the answer is no. So for the new employers out there, if you anticipate that you're going to have 50 or more full-time equivalent employees, you're a large employer at that date. So with that, Sean, I'm going to turn it over to you.
All right, thanks, Tanya. So yeah, we get a lot of questions still on the applicable large employer or ALE question. You know, we've been working on these forms for 5 years now, and it's still an important consideration for, you know, employers around that size where you're just under the 50, and or sometimes you might be just over the 50, and then there's questions about this year with COVID and furloughs and considerations like that. So it's an important point that Tanya touched on earlier around furloughed employees, that it doesn't change your calculation for this year, but it would change your calculation for 2021 potentially. So with that, we'll get into some of the ACA other background areas. So we touched on, ALE status, and that's important because it gets to whether we have these pay or play penalties to us. So remember, these pay or play penalties are for applicable large employers or ALEs. So the first one that Tanya touched on earlier is the 4980HA penalty, which is for employers that don't offer health insurance. And that penalty for 2020 is the $2,570 amount that Tanya, I think, alluded to earlier, and that is per full-time employee. So it exempts the first 30 from the computation. So if you have 100 employees, you'll see in a later slide, the first 30 are taken off. You'll see how that calculation works. And another thing to keep in mind on that is the penalty comes about if one person goes the exchange and gets a subsidy or a premium tax credit on the public exchange. The other penalty that Tanya talked about a little bit earlier is the 4980HB penalty, and that's the penalty if an employer is offering insurance that is unaffordable or doesn't meet minimum value, and that penalty is $3,860 per year per full-time employee receiving that premium tax credit subsidy. And then if you do, there is that calculation, it is maxed out at the A penalty, so it can't exceed the A on employees. So if you have a lot of employees that are getting that penalty, just one thing to keep in mind is that it can't exceed the A penalty calculation. And then a little piece on minimum value. So I don't know if you remember that or not. It'll be on your summary plan document or your summary benefits coverage that you send out to employees every year. And it'll spell out right there, does this plan meet minimum value? It'll either say yes, or it'll say what that calculation is. And basically what it is, it's an actuarial calculation looking at your plan and saying, does your plan premium fund at least, I believe, 60% of your total costs under that plan? So if it's above that threshold, then it meets minimum value, and then you're okay. So if the premium meets at least that percent of all your costs under your health insurance plan on an actuarial average, then it meets minimum value. If it doesn't, then it doesn't meet that threshold. We haven't seen many that go over that, but we have seen a number of plan designs that didn't meet minimum value. And I think a lot of those cases, individual employers didn't realize that they weren't meeting minimum value in that plan design. So kind of more of a plan design question than anything else. Those are the two penalties there. If I can there we go. So again, I was talking about how the A penalty is calculated. So here we have that on that slide. So we have the $2,570 penalty amount per employee, per full-time employee. Again, the first 30 are exempted from the calculation. So if you look at the example, we have 100 full-time employees. One goes to the exchange and gets a premium tax credit. Not only qualifies, but receives a premium tax credit. Then that penalty is 100 less 30. So you got 70 full-time employees times roughly $2,500 or $2,600 per month, which would equate out to about just under $15,000 per month, or about $179,900 annually penalty. And again, just to note how it's triggered, how that penalty can be triggered is if it's one full-time employee that goes the exchange and receives that premium tax credit. So if nobody does and they qualify, then there's no penalty. If one person gets that tax credit and you didn't offer health insurance, or as you'll see, you offered to less than 95%, then you would be subject to this penalty. And again, like most penalties, this one is not tax deductible. So on the B side, a large employer offers insurance. That penalty could be there if you offer insurance that's unaffordable or doesn't meet minimum value. Again, that penalty amount is $3,860 per year if they go to the exchange and receive a premium tax credit. I touched on that eligibility for the tax credit. Again, it's unaffordable, so I think we have that on the next slide what that percentage is. It started out at 9.5% and it roughly increases every year due to the consumer price index or inflation. We'll see what that is for 2020. And then there's that inadequate question as well. So if it meets either of those, then that person's eligible for that premium tax credit. And again, it's capped at the A penalty. So if you have a lot of employees that have unaffordable coverage, go to the exchange, it's capped at the A penalty. So it won't exceed that. Which will bring us to our first polling question. So I think that should pop up. The question is what is the penalty for an employer with 55 full-time equivalent employees who does, and that employer does not offer health insurance to any of the 46 full-time employees, and it's assuming that one full-time employee receives a premium tax credit from the exchange. So what's the penalty? Is it either $141,350, $41,120, $3,860, or $0? So what is the answer there?
All right, looks like polling has pretty much stopped, so I'm going to close this and hear the results.
Okay, interesting. We got results kind of more or less across the board. So the question is worded, well, it's worded fine, but the answer is 41,120. So the key phrase there is who does not offer health insurance. So this employer actually did not offer health insurance. So the penalty would be the 46 full-time employees less the initial 30. So 16 employees times that roughly $2,500 penalty, which gets us to the 41,120. So next we'll get into the safe harbor. There is safe harbors for employers to get out of that, to get out of the B penalty. We need to put it on the 1095-C, which is why it's important to accurately calculate affordability and to accurately portray or put that on the 1095-C. So there's three safe harbors available. And what the affordability looks at the employee portion of the self-only or single premium for the lowest cost of coverage that provides minimum value. And so you look at the lowest one. If you have a high deductible and a PPO, or a high deductible and a major medical or something like that, your high deductible is most likely the lowest cost plan. So you would look at that if you offer multiple plans. If you offer one, then it's easy. You just look at the one and you look at the monthly premium and you make sure that it doesn't exceed 9.78% of the employee's income, and that income is based on one of these three criteria. So you can look at either the W-2 method, which is that first bullet point underneath it. Wages, in this case, equal box 1 of the W-2. So you compare the premium either over 12 months or on a month and compare it to the box 1 of their W-2. So if you do it most likely on an annual basis, you would get the wages on box 1 of the W-2 for the year, and then take the premium over the 12 months and compare the two and make sure that they are under that 9.78%. The other method you can use is the rate of pay method. So you can look at their rate of pay at the start of the plan year. And if you have fiscal plan years, there's a lot of 6/30 plan years. So you got to look at the rate of pay as of July 1st of that date. So we'd have to do it twice for the reporting. You look at the rate of pay at the first of the plan year and then multiply it times I believe it's 130 hours, and that will get you their rate of pay for the month. And then you would compare the premium divided by that rate of pay number, and you would see whether you are above 9.78%, or if you're under, then it would be unaffordable. So there's some trade-offs with those. The box 1 of the W-2 is more income if they're working more than 30 hours a week, typically. So that makes the W-2 method a higher income amount. On the other hand, the W-2 is reduced by any pre-tax items, like if they're pre-taxing premiums or retirement or dependent care, which I fall under. If they have any of those that are reducing W-2s, then that W-2 number would be reduced by those items. So rate of pay, the benefit is it's the full rate for an employee. The downside is it doesn't, a lot of employees work 40 hours a week. Doesn't take into account 40 hours, it takes into account 30 hours. So, which method you use, it depends on, which employee has affordability for which method. The key thing there is you need to use the same method for a group of employees. So you can't cherry pick which method for which employees. You gotta make sure you're using the same method for the same employee class. And that's kind of a broad definition. So we just want to make sure we're consistently applying that definition across all of our labor force. So if you have different union groups or different employee types, then as long as it passes a consistency test, I think we could go with it. We don't typically change the method, but in the rules, you technically could. The other method to touch on is the federal poverty line. And so with that, you take the premium divided by the federal poverty line to see if it's affordable. That federal poverty line that you use for 2020 is the 2019 federal poverty line level. So in that case, for the mainland United States, it's $12,490. So you would take the premium over 12 months divided by 1290, or your premium for the month divided by 1290, or 12,490 divided by 12. And down below there, we have what that premium amount is. So technically, it can't fall below $101.79 for a 2020 plan year. If it does, it would be unaffordable. If you are more than that, or I'm sorry, if it's more than that, it would be unaffordable. If it's less than $101.79, it'd be considered affordable. So if you're under $101.79, it's an affordable plan for the poverty level. That's nice because you can apply that across the board for all your employees. So it's under that $101.79, it's affordable. If it's above it, then you would want to look for the other two methods, either the W-2 or the rate of pay. So I touched on with the A penalty, one of the areas that is overlooked is this 95% rule, which is in the ACA regs. Basically, if we're offering coverage to all of our full-time employees, we need to make sure that we're offering to 95% of our full-time employees for every month of the calendar year. If we don't, it's treated as if we're not offering insurance at all on the forms. And we would be subject to the 4980HA no insurance penalty. So that's a biggie. I mean, if we're measuring employees and we're seeing who's full-time and we have 100 full-time employees and we offered to 94, it's good. We offered a 94, but on the other hand, if the IRS caught wind of that and we weren't compliant, then we weren't compliant with this 95% test. It's as if we didn't offer coverage. They could put that 4980HA penalty, or that $180,000 that we talked about earlier. They would apply that for a 100-sized full-time employer. So they could put that on top of as a penalty. And that would be, if you look at how much insurance costs, it costs us however much, but it also costs us this $180,000 penalty because we didn't offer to 95% of our full-time employees. So we really want to make sure that we're meeting and compliant with that rule. So some other things with that rule is you can use 5 employees if it's greater than 5%. So if you have 50 full-time employees, you can use 5 employees as the count. So if it's greater than 5% of the non-offers. Again, if it's not met, another thing is you can't use affordability safe harbors. So it kind of runs into the A anyway. So you'd have the A penalty. You can't use affordability safe harbors for anybody else. This gets into a major reason why we look at the look back measurement method, is because that really locks in employees as either full-time or part-time. Where we see some issues with the 95% rules around employers that use a monthly method, because you might have employees that are part-time a lot of the year, but you'll have them trip into full-time during a couple months of the year. And if they're not seasonal, you'll run into issues where, okay, we didn't offer to that employee in March, April, and May, let's say, for example. Okay, well, are we under that 95% rule for March, April, and May? And then sometimes we'll see that where employers didn't know that, and then they fall under for those months. Well, then on the 1094, we can't say we offered coverage to substantially all full-time employees in those months, and that triggers this penalty to the IRS. So for those months, we would be under the 95% rule, which means we would have that penalty for those 3 months of the year. So again, it's an important point in the ACA rules. A major reason why I use the look back method, because if you did, then those employees would probably be considered part-time for all of those months, because as you'll see in a later slide, we're going to average those hours over the 12 months, and that would make that employee part-time. So we wrote an article on this to kind of explain the point more. So when you have some time and you want to look at this 95% rule, click on that hyperlink or look for Google Eide Bailey, two unlikely cousins. Hopefully that shows up. If it doesn't, you can reach out to Tanya and I. We can send it to you. It's a nice, I think it's 2-page article, kind of outlining a case of applying the 95% rule to someone that uses the monthly method and someone uses the look back. And the implications of that is that the look back client employer wouldn't have a penalty, and the monthly method example would have the A penalty. So that gets into some terms on the monthly and the look back method. So, when you're looking at these forms and offering coverage, some of the things to look at in terms is the waiting period. So a waiting period is how long you have between when an employee starts with or rehires with a company or starts with a company and is technically offered health insurance. So the ACA has a rule that says the waiting period can't exceed 90 calendar days. So we just want to make sure that we are within the 90-day rule. There's also a term kind of coincides with it that's a limited non-assessment period. That rule, that term says that you can't you can have a limited non-assessment period for up to 3 full calendar months from when you hired an employee. So it can exceed 90 days in that it can be 3 full calendar months. And on the 1095Cs, you can put this code 2D on line 16, which says, no, they're in a limited non-assessment period, which essentially mimics the waiting period. It can be a little bit longer. We try not to do that because we don't want to run into waiting period penalties. But the limited non-assessment period can be up to 3 full calendar months. Then we get into the measurement methods. There's the monthly method I talked about earlier, which is the default to determine whether an employee is full or part-time. That method is looking at hours for every month and seeing if that employee is full or part-time each calendar month of the year. And so you can look at that and basically if you're using, from the first of the month to the end of the month, you look and go, okay, did they work 130 hours or more in that month or not? If they worked more, then they'd be considered full-time. If they worked less, they'd be considered part-time. Then you can check the other approach, which is a look-back method. You can look at hours over a designated period of time for anywhere from 3 months, which we hardly ever see, to 9 to 12 months, which we see probably 90% of the time, 80 to 90% of the time. You can use a 12-month period of time and look at that period and go, was that employee working 30 hours or more a week on average over that entire measurement period? So that helps because obviously you can average those hours in all those months over a long period of time and designate whether they're full or part-time over that period. So there's terms within that measurement period, which is the initial measurement period, which is when the employee started and they're considered variable. We don't know whether they're full-time. If you don't know, then you can place them in an initial measurement period and measure their hours over that. And then after that, you can offer coverage if they're full-time or not if they're part-time. Then we have a standard measurement period, which is our standard approach to measuring ongoing employees, all employees that we have that are in that period. That's likely 12 months to see if they're full or part-time. Then we have a stability period that coincides with those measurements. That's essentially the same length as those measurements, and their stability period is there. They're locked in as full or part-time. They're locked in. There's no penalty potential if we offer to all our full-time employees, throughout that stability period. Then there's an admin period, which is the period in between your measurement and your stability period. If it gets a little confusing on the timing, we have slides coming up that will outline this in an illustrative form that's kind of helpful. Oh, I'm a little fast there.
So Sean, this is me. Let's just skip right to the, I think we have a polling question come up, and then why don't we go right to the slides where you can show those 2 periods. I know we have more slides than we probably needed to have in this presentation, but we're going to try and be cognizant of the time. So I think you need to do your second polling question and then kind of walk through the measurement periods, if you will, over on the charts that you have.
So our second question, if you can pull that up, I have it here in front of me too. What slide? Yep, there it is. So Sam gets hired as a full-time employee for ABC Company, which is an ALE. Sam works 1,600 hours in the initial measurement period. ABC Company will not be subject to a question is ABC Company will not be subject to a penalty if they offer him coverage 30 days after initial measurement period. Is that true or is that false? Okay. So here's an example of a measurement period for a newly hired variable employee. So we have a new variable employee. Jennifer is a new employee who started August 1st, 2018 for XYZ Company. XYZ Company chooses a 12-month initial measurement period starting on Jennifer's hire date, 8/1/18, then to 7/31/19. XYZ's standard measurement period is 6/1/19 to 5/31/2020. There's admin periods associated with those measurement periods. So if you're a new employee, it's August 2019, and the ongoing employees have an admin period in June. And then we'll illustratively show that on, on a couple slides. But we're going to continue with that example here. So in that example, she averages more than 30 hours a week during the initial measurement period, 8/1/18 to 7/31/19. So as a result of that, she would be considered a full-time employee from 9/1 to 8/31 of 2020. So during that stability period. And then the company must also track her hours during the standard measurement period. And if her hours during that period are greater than 30, then the company must consider her a full-time employee during that stability period as well, which is 7/1/20 to 6/31/21. So we have to measure two measurement periods for this employee because they were hired variable, and we had to measure her during the IMP and also the initial measurement period, and also during the SMP during the standard measurement period. So graphically or illustratively, here's how it kind of lays out. We have, an 8/1/18 is month one. We have an IMP to 7/31/19. Then there's an admin period in green for a month. Then she'd be placed in a stability period on 9/1/19 to 8/31/20. So she'd be either locked in as full-time or part-time during that period of time. Then we also have our standard measurement period starting June 1st or 6/1 and goes to 5/31, so another 12-month measurement period there. We have a 1-month admin period following that, and then starting the first after that 1-month admin period is the standard our standard stability period, which is July 1st or 7/1 to 6/30/2021. So, and that typically follows 90% of the time we see that stability period following the plan year. So this could likely be a 7/1 health insurance plan year. So we kind of stabilize stability period from that, and we kind of build the timing of when the admin period is and the measurement period from that point. So we kind of start with the end in mind and then work our way backwards. I think that was on a later slide, so I just want to point that out. Example 2 is the same facts, but the employee is instead full-time. So then the employee is hired on the first month 1, and then the employee has a waiting period for 2 months. We set a 2-month wait period in this case, or 60 days, which is typical. And then no initial measurement period since they're full-time. No initial stability period again because they're full-time. Then they're measured like all employees are on the standard measurement period on 6/1, which goes to 6/1 to 5/31 of the next year. And then they would be in the standard stability period on 7/1/20 to 6/30/21. They'd be in it at that point. They'd be in a stability period at that point. So the look back measurement period offers some flexibility there with determining who's full-time and who's part-time and measuring hours. Like we showed there, it's not as, I guess, rigid as the monthly because you need to offer to everybody on the months they're full or part-time. So you got to keep careful track under the monthly method to make sure we're not falling under that 95% rule. The look back measurement method is a nice way to go because it seeks to minimize that 95% issue. But there's, as you can see, there's timing and administrative considerations, and there's rules that we need to take into account. I'm going to pass off to Tanya here soon, and she's going to talk about some of those rules. There's other rules around rehires and things that need to be correctly understood and built into a model or any type of software you're using to make sure you're implementing correctly. Some organizations have missed offering a part-time or variable employees who end up being full-time. We've seen this for large and small companies that have implemented the measurement period. So that's an area to keep in mind. And category changes, as well as that third bullet point lays out, you want to make sure that you're accounting for category changes correctly. So I believe with that, I'm going to pass it back over to Tanya, who's going to continue to talk about some of those nuances on the measurement period.
Awesome. And to Sean's defense, he said, Tanya, your slides, you have way too many. And I said, I know. They can read what we don't get through. So on the slides that we're going to skip, I'll skip through some as well. Please read through them. There's a lot of good information there. If you have questions, send Sean or I an email. I just looked up that polling question, and I think most of you said, it said Sam gets hired. He gets hired as full-time, works 1,600 hours in the IMP. He's offered insurance 30 days after the IMP. Will there be a penalty? There will be a penalty because he was offered full-time. You don't get an IMP if you are hired as a full-time employee. So watch those offers to those full-time employees. They get a standard measurement period, but not an IMP. So now we're going to talk about a change during the stability period. So obviously when we have someone who's full-time and they're full-time due to the look-back measurement period, they are locked into their status during this following stability period. Well, there is a way to get that person out of being a full-time employee during that stability period if they change statuses. So if they take a part-time position, and if they work that part-time position and work under 30 hours a week for 3 full calendar months, and if they were offered insurance that met minimum value back when they were hired, then on the first day of the 4th month, you can classify them as part-time and they can be measured monthly going forward until they complete 1 full SMP. Now remember, an offer of COBRA coverage is still an offer of coverage. However, it's probably going to be deemed unaffordable. So special unpaid leave, nothing new here. Just remember, if we're using the look-back measurement method and we have someone on one of these following special unpaid leave, that's your FMLA, your military, or your jury duty. Let's say that I take a 2-month military leave. For my look-back, I'm only going to use 10 months for the look-back. So if I work 1,300 hours, I'm a full-time employee for the following stability period. So hours of service, remember we include our vacation hours, our holiday time, all of those hours down below are included, nothing new here. Employees that are rehired, we see this missed a lot. We see it by both employers and insurance companies. So if we rehire someone within 13 weeks, whether we use the look back or the monthly measurement method, we have to offer them insurance as soon as administratively possible. And then the regs go on to say that the first of the following month is deemed as soon as administratively possible. So they don't get a whole new 60-day waiting period if that's what the employer's waiting period typically is, or they're not going to, you're not going to abide by the rules behind the ACA. So remember that 13-week rule turns into a 26-week rule for anyone that's an educational institution. So ACA considerations when it comes to furloughs. So if you furlough an employee, if you're using the monthly, obviously they're not hitting 130 hours a month. You're not going to be open for any penalties in those months. But if you furlough someone and they're in their stability period and they were deemed full-time, you need to offer them coverage during that furlough. Remember, if you take away their coverage, put them on COBRA, which typically isn't what employers are doing, that COBRA, if it's not affordable, they could go to the exchange, receive a premium tax credit potentially, and then you could get hit with the 4980HB penalty. So watch those furloughs, watch those offers, again, if they're deemed full-time in that stability period. Reimbursement of individual premiums, nothing new here. I just oftentimes see too many people doing this. Remember, that's that 4980D penalty we had talked about earlier, and that's $100 per day per person that you're doing that to. If you don't have an ICRA set up, don't reimburse for individual premiums unless you have a QSARA set up or that one individual HRA. So here's our due dates. Remember, we don't have an extension on our due dates yet. We have a couple dates that fall on a Sunday, so therefore the due date goes on the following Monday. So penalties. We are going to want to make sure that we do these forms correct because we don't know if we have a good faith effort going into 2020. Here are some of the penalties that could apply. I do have a chart coming up for these different penalties. Remember, we had a good faith effort for the prior year. Again, we don't know if we have that for 2020. So now on to polling question number 3. Furloughed employees that are deemed full-time employees due to the look-back measurement period will be automatically deemed to be offered affordable coverage during their furlough. So if you want to take that and answer that, please. So here is a chart of your 2 penalties, depending on your employer size. So here's some misconceptions. So all of these statements are incorrect. Unfortunately, we've obviously seen these statements come up or they wouldn't be listed on here. So remember, if you're a self-funded employer, you will have to file forms, you will have the 1095B forms to file. Oftentimes I hear companies say, well, we didn't file any forms because our insurance company filed them. Well, the insurance companies are filing the 1095B forms. They are not filing the 1095C forms for large employers. Oftentimes, people will think their payroll company is doing them. That's a separate module. Also, you need to make sure that if your payroll company is filing them, oftentimes they're allowing you to input that information. And remember, the output's only as good as the input. So make sure that you put good information in to get good forms coming out. Again, we said 2018, people thought that since that was the year the individual mandate stopped, it was the year that the employer mandate stopped. That is not true. I'll let you read the following ones, the remaining ones on your own. So we're going to talk about those 1095B and 1095C forms. Remember that if you are self-funded, again, you have a 1095B form. If you are a large employer, you're going to file the 1095C forms. Remember, you have to consider control groups. So if you are a small employer, but yet you have someone who's related to you, it could make you file the C forms instead of the B forms. We've had clients that inadvertently mess that up. They file the B forms and they didn't take into consideration the related entities. So in a couple slides, I have some common errors that we see on this 1094 form. I'm going to go through them while you're looking at the form and you can read through them later. So if you are filing this form and you're not filing it for different divisions, line 18 and line 20 should be the same number. So you should have the same number of forms filed for line 18 as well as the same number of forms submitted with this 1094 form. Remember, if you're paper filing these, you're going to want to sign and date it or it won't be accepted. If you offer that insurance to 98% of your full-time employees, look at that offer. Make sure you're meeting that requirement. The nice thing about that is then you don't have to fill out column B on this page 2. Remember 23, line 23 for all 12 months is probably your most important box. That's the one we see being missed most often. Another thing I see employers doing on both the 1094C here as well as on the 1095C is people fill out all 13 columns. You don't do that. You either fill out the all 12 months column or each individual month. It's either or, you don't do all 13. And every single employer will always fill out column C, again, all 12 months or each individual month. Now, I didn't put on page 3 of the 1094C. Remember, that's if you have those related entities. Then you will fill out page 3 and you're going to list that entity's name as well as the EIN number. And you're going to list them in descending order from the largest of the full-time employees down to the smallest. Obviously, you don't include yourself when you're filing that form. So here are our common errors on the 1094-C. We touched on most of those. Please review these before you submit your form to the IRS. So here's our brand new 1095-C form. As you can see, this is only page 1 of the 1095-C form. Page 2 is nothing real great. It's just got the covered information on it. New here, you will see that it's asking for the employee's age on January 1st. Then in line 17, it's also asking for that zip code. Now, we don't have the instructions out yet for this form. I'm anticipating that the instructions may tell you that that information is going to be used if you're offering an ICRA to those employees. However, the employer might not know if that ICRA is, if that offer of coverage is because of an ICRA or not. So once those instructions come out, we'll see if we have to put that zip code in for everybody or just for the individuals that have that ICRA. So here are again our common things we want you to be aware of, or mistakes that we've seen. Line 15, you always enter the cents. So if your premiums are $100, you enter 100.00. So here are the new items that we talked about. Remember, page 2 of the 1095-C is that self-funded information. So here is some common coding. Nothing has changed here. You're going to want to watch for the 1H2Es if you have union employees to see if we're still allowed that coding this year. Like I said, we don't have those instructions out yet. One common error I see a lot is that 1G code being misused. If you are using a 1G code, it has to be used for all 12 months, and it's for employees that are not full-time. So those employers that have self-funded plans, they would be the ones that are using the 1G code. If you have a fully insured plan, you would never use a 1G code. So here's some COBRA offerings, how to code those. Nothing again here has changed from the prior year, so I'll let you read that on your own. So now polling question number 4. Pat, a part-time employee, was offered minimum essential coverage that was unaffordable for a self-funded ALE. What coding should be used for his line 14 and line 16? While you're answering that, the last polling question was furloughed employees are deemed full-time employees due to the look-back measurement period will automatically be deemed to have an affordable offer of insurance through their furlough. The answer was false. So, Amy, is it all right if I give this answer and then move on while they're still answering? Okay, so the answer to this one is number 3. So a part-time employee, remember you're only giving them a form because you must be self-funded. So the answer is 1G. So here's some common errors we often see. So one of the things that we do for employers is if they do their own forms or if their payroll software does the forms, they'll send them to us and we'll review their forms before they submit them to the IRS. Each year we get a little bit, our employers get a little bit better about doing the forms. Last year we were just over 2% of the forms that we reviewed. I should say that the employers that we reviewed their forms were correct as is. So that percentage should be higher, so please review your forms. If you don't have someone qualified in your office to review those forms, send us an email and we'll let you know if we have time to review them if you hadn't signed up yet. This is why I say that. So back on June 10th, the Treasury Inspector General for the Tax Administration released a report on what they found with the IRS and how the IRS is going about these ACA penalties and looking at those penalties. Now, in my opinion, if you read through that, I would say they got a bad report card. Basically, they're only bringing in a fraction of the anticipated penalties, and some of that is probably because the IRS is being a little too lenient, especially on that good faith effort. So in the report, it stated that the same employer is making the same mistake 2 years in a row, and the IRS is letting it go. So what's the takeaway here? Will we finally have no good faith effort coming into our 6th reporting year? I would think it's about time we start getting the forms right. So I wouldn't be surprised if the IRS says, listen, we didn't get such a good report on the 10th of June. We're going to take away that good faith effort reporting, and therefore you're going to be subject to a couple of penalties, the 6721, 6722 penalties if you're giving out incorrect forms. So we have 3 minutes. I am going to go right up until the last minute, if that's all right. And if you have questions, you can stay on later to get your answers or send them via email. So letter 226J, those are those pay or play penalty notices that employers are getting from the IRS. Oftentimes we look at these penalty notices and usually I can tell within maybe probably 5 to 10 seconds of what's wrong, what you did wrong when you were filing that form if I could see all pages of that notice. Typically, it's because your 1094 was submitted incorrectly or filed incorrectly. I have employers that are giving forms to all of their employees. They think, hey, let's just cover our bases. We're going to give them to everybody. Well, each form that you put out is a potential penalty coming back in. If you're not self-funded, part-time employees shouldn't be getting a form. Make sure your COBRA offering is being done correct. If that employee is not working for you and you code them as working for you, but they're receiving an unaffordable offer, of course, it's going to be a penalty that the IRS is going to assess you on. If you truly laid that person off, terminated their employment, and they are on your COBRA coverage, there's a specific coding for that to let the IRS know that, so you're not on the hook for those. Here, I'll let you read through some other errors that we typically find on these. When you do the letter 226Js, these are all information that you're going to want to back up with that response to the IRS. So your letter 5699, those are those notices coming out to employers saying, hey, we didn't get any forms for you and we think you might be a large employer. Where are your forms? Now, just like the letter 226Js, you have 30 days to respond. Please don't go over that 30 days. We can get extensions on those, but once you wait 5-6 months and don't open that letter, it's really hard to work with the IRS for obvious reasons. So remember, if you have 250 or more forms, you still have to file those electronically. Now this 972CG penalty, we have seen some of those come through, and it's because the forms were filed late or they were paper filed when they were supposed to be e-filed. We haven't seen any come through yet on missing or incorrect tax identification numbers though. So statute of limitations, I don't know if many of you caught this, but I believe it was in February this past year that there was a chief counsel memorandum that came out that said there's no statute of limitations on these forms. That being said, keep all of your backup data all the way back to 2015. The reason is they can't correctly assess the penalty because they don't know this until the individuals go to the exchange and receive a premium tax credit. So not good news for our taxpayers out there. Keep that documentation. Be proactive versus reactive. Look at your prior year forms. Start with 2017. The IRS should be wrapping up their 2016 forms. So I guess I would, like I said, start with 2017, see if they're filed correctly. If not, get an amended form filed before you get a notice from the IRS. Easier to amend a form than to deal with the IRS. So here is what you want to do coming into this year. Have all of this information again in a file that you keep forever. Here's what we can do to help you should you need our assistance. With that, I am right at noon. So Amy, I don't see that there are any questions out there, but maybe I'm not looking at that correctly.
Nope, you are correct. I don't see any questions.
Okay, so with that, thank you everyone for tuning in. We do have some roundtables coming up. We have 2 more remaining. They're in September and in October, those roundtables. Sean and I go on there and we just simply answer questions that employers are asking of us. So once you sign up for a roundtable, it's a free event. It's a 30-minute roundtable, so it's not eligible for CPE. You can submit your questions there. Otherwise, there is Sean and my contact information. If you have questions, please send us an email or give us a call. With that, thank you everyone for joining us today, and please stay safe.